S&P 500 is up over 30% over the past year, but Uber stock is actually down 2%. Today, I'm going to look at this dip in Uber stock and see if it presents an opportunity to buy. Now, as is usually the case with stocks that are down, there's a lot of uncertainty surrounding the underlying business lately. Over on my Discord server, we were having a conversation about Uber recently. By the way, I have a Discord server. It's totally free. You don't have to do anything. There's a link in my description to join if you like to talk stocks. Come and join us. It's a great group, great community. Highly recommend it. Anyway, we were having a conversation on that server, and somebody brought up Uber, mentioning that the price looked pretty attractive. Naturally, that sparked a little bit of a debate, and what I liked is that the debate wasn't just talking about how great Uber was, it was also pointing out the bear case around Uber. One of my friends over on Discord mentioned that Uber has a history of some shady things like tax evasion and underpaying their employees. And a few people echoed that autonomy and the Tesla robotaxi and things like Waymo might present some pretty fierce competition to Uber. However, on the flip side, those types of things are still a ways away, and in less developed countries, it's going to take even longer for those types of things to catch on. So this recent sell-off in Uber over robotaxi on autonomy fears might be overblown. So let's take a look at Uber's valuation today and see if it might be a buy. So Uber has one key competitor, at least here in the US, and they're expanding to other countries, but that is Lyft. And Lyft only has a 24% market share in US rideshare. Uber commands the other 76%. So Uber, 3 times as large in terms of market share than its little brother Lyft. Typically, you're not going to see a direct correlation between the market share and the valuation. So what I'm saying is that Uber is going to be valued much more significantly than Lyft, more than 3 times more than Lyft. And you might think, oh, that means Lyft is undervalued. Not necessarily. There's a lot of reasons why it makes sense to invest in a leader by market share. They tend to have economies of scale, they tend to have better growth, and they're typically better investments over the long term, not always. But that's why I'm looking today at Uber and not Lyft. I imagine most people watching this video are familiar with Uber as a company, but in case you're not, or if you're curious, they break down their business into 3 different segments. The largest is mobility. Now this is their rideshare platform where their independent contractors / employees go to pick up a passenger and drive him or her to a new place. Mobility. Quite straightforward. Essentially, they have disrupted taxis in that regard. The second largest segment is delivery, and that is their Uber Eats app. It's not just food. They do deliver food, but they also deliver things like groceries for people who can't / don't want to make it to the restaurant or grocery store. And finally, they have this very small segment, which is freight. It's also not growing very fast. And that segment is simply where they connect shippers with carriers for most types of delivery. I believe that this is mostly smaller packages. We can see that mobility is their largest segment, and it's also growing the fastest. They recorded almost $6.5 billion in mobility revenue in the past quarter, and that's up 26% year over year, delivery up 18% year over year, and freight much smaller, only 2% year over year revenue growth. And that led to overall revenue growth of 20% year over year in the most recent quarter. So you might think, okay, a company that's growing that fast probably has a pretty high valuation. Well, it actually doesn't. This is my growth stock spreadsheet where I rate growth companies on 4 factors, which include gross margins, annualized revenues, price to annualized sales, and quarterly year-over-year revenue growth. So the stocks listed on your screen right now are the highest rated stocks on my spreadsheet, and we can see that Uber is up here in 10th place, which is pretty good because there's quite a few stocks on the spreadsheet. Essentially, I give each company a score based on those 4 factors I mentioned, and I aggregate that score for a total possible of 20. I've never seen that. I think it would be quite impossible to get a score of 20. My average is actually around 11.5 right now, so Uber is well above average here with a 13.4. So let's talk about this score. So Uber has an impressive $45 billion in annualized revenue. So this is a massive company. Their market cap, on the other hand, is only $130 billion. So their price to annualized sales is less than 3. This is really low compared to the average growth stock that I look at. It's not uncommon to see growth stocks with price to annualized sales in the double digits. Now we need to keep in mind that usually when companies have price to annualized sales in the double digits, they have also high margins. So high margins, high growth. It's typically things like software companies. Uber doesn't quite have those high margins. Their gross margins are only 39%, but that's still quite respectable. For reference, the minimum that I consider for investment is around 20% gross margins. So Uber has almost double that, and they're showing that double-digit revenue growth. We can update this to 20. It doesn't change their score too much. So Uber, very highly scoring stock on my growth stock spreadsheet. So let's dig into it a bit more. If you know me, you know I love a good balance sheet, and Uber, one of my criticisms of this company in the past is that they have had a lot of debt. debt on their books. So I figured I'd check in and see what's going on these days. So they have current assets, that's anything that can be turned into cash within a year, of $15 billion. And they have current liabilities of about $11 billion. Okay, so that's cutting it close, but realistically, they have an extra $4 billion that they can play with in the short term. And as far as total liabilities, they have $30 billion. Total assets of $47 billion. However, $8 billion of this is goodwill. Now, if I've lost you here, goodwill is a fake asset, to put it bluntly. Essentially, goodwill is when a company makes an acquisition or somehow acquires an asset. If they overpay above the tangible value, this is called goodwill and is put on their books. And typically what happens is that companies have to write this off because it's not actually worth anything. So if we take out that quote unquote fake asset, and I know it's not really a fake asset, it's technically an asset. However, it's intangible. It often gets written off. Let's take that out. They still have $39 billion of total assets, $30 billion of total liabilities. Okay, so they're not underwater. They do have a positive book value. Their assets are greater than their liabilities. When we look at debt, most of this debt is long-term. So this is things that come due in greater than a year, and their long-term debt is around $11 billion. Is that going to be a problem? Well, probably not, because Uber is now generating some really solid free cash flows. We can see that in the most recent quarter, they ended the quarter with $9 billion of cash and equivalents. In the same quarter in the previous year, they had less than $7 billion in cash and equivalents. So each year, they're generating just over $2 billion in free cash flows. If they have $10 billion in long-term debt, it would only take them 5 quarters or just over a year to generate that much free cash flow to pay off that debt. So realistically, Uber's balance sheet, not that bad, right? They have a lot of debt, but they have strong free cash flows, and a lot of that debt is long-term, so it's not coming due anytime soon. One other metric I like to look at before deciding if a stock is a good investment is their shares outstanding. So when a company needs cash, they can sell more shares, which increases the shares outstanding. And when a company has extra cash, they can buy back those shares, which helps out their shareholders because it gives them a bigger portion of the overall company of ownership. And what I don't love to see is that Uber's shares outstanding have been steadily increasing. So that means if you've been a long-term shareholder, you've been diluted over time. All this means is that let's say you own 1 share of Uber. If the total shares outstanding goes up, but you still have 1 share, your share is technically worth less of the overall company. So that's dilution in a nutshell. Uber has been diluting their shareholders. However, it's not too severe, and it is quite common for tech companies because of what's known as stock-based compensation. A lot of times, high-level employees will be paid in shares. Those shares have to come from somewhere. They're usually created out of thin air, and that's one way that Uber can pay their high-level employees is with shares. It helps to align those high-level employees with the success of the company. So this is relatively normal, though it's not great to see. Finally, let's take a look at Morningstar. This is an investment research website that I happen to like. They're not perfect. They're not trying to predict the future, but they do have a team of pretty good analysts who like to give their 2 cents on different companies. So Morningstar rates companies based on their valuation. So a 1-star company would be overvalued and a 5-star company would be significantly undervalued. They rate Uber at a 4-star, so that's slightly undervalued. They believe that Uber's fair value is $80 a share, and is currently trading at just over $61 a share, so about a 25% discount. Now, this is what they think shares are worth today, not what they think shares should be worth in a year. So they're saying that if you're buying today, you're buying Uber at a 24% discount, essentially, right? This is just their best guess. When we go into the report by their analyst here, they say that they view Uber as a leader in a fast-growing rideshare market, which they expect can reach more than $600 billion by 2028. Now, they no longer operate in China, and they also no longer operate in Southeast Asia. So while they're getting out of these major markets, it's probably not the worst business move. They had a lot of competition from Didi in China and Grab in Southeast Asia. They actually now have a partnership with Grab, as someone on my Discord pointed out correctly. Back in 2018, they made this announcement that they are combining their Southeast Asia Uber business with Grab. So in exchange, Uber is going to get about 28% stake in this new combined company. So they are now partners as opposed to competitors. Uber has a vested interest in Grab's success. So going back to the threat of autonomy, I can understand the sell-off. So the United States is most likely to see autonomy faster than other countries, especially with the new legislation change that the United States is going to see in 2025 that we know to be quite friendly of autonomous vehicle legislation. This doesn't bode well because this type of thing can displace Uber, because it's probably going to be a lot cheaper to take a robotaxi than to pay an actual human to drive you from place to place. However, autonomy is still a ways away, and Uber's valuation looks quite cheap. Everything with the company currently is still trending in the right direction. They're seeing strong and accelerating revenue growth, they're seeing stronger free cash flows, expanding profit margins, and their balance sheet is steadily improving. So if you were asking me to buy Uber and hold it for the next 100 years, I don't know, there probably would be some disruption that comes within that time. But if you're asking me if Uber is a good investment today, knowing what I know now, it looks pretty good. I think by the time autonomy arrives, Uber will probably find a way to deal with this threat, whether it's implementing their own autonomy solutions, expanding their partnerships with things like Waymo and Tesla, they already have a partnership with Waymo, or whether it's simply adopting their own fleet of autonomous vehicles and pivoting hard into the delivery game. I think Uber still has a lot of potential. And as I said in my Discord, a lot of times when there's a threat facing a company, the market tends to sell it off a little bit too much. One example that one of my subscribers gave is Netflix. When we think about Netflix, they reported their first ever decline in users, and that sent the stock down something like 70% from their peak in less than a year. However, look at Netflix now. They have weathered the storm and are now back to new all-time highs. So I'm not saying that this exact thing will happen with Uber, but what I'm saying is that it's possible, right? A lot of times people overestimate the threats, when in reality, the underlying business is probably still safe, at least for the time being. So I'm definitely considering opening a position in Uber, and I will definitely let all of my YouTube members know as soon as I do, if I do. If you guys liked this video, please hit the like button, and if you're new, please consider subscribing. It really helps out the channel a lot. And let me know down below what you guys think of Uber. Is it dying, or is this a great time to buy the dip? Thank you guys so much for watching, and I hope you have an amazing day.